Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of GeoDataVision.
Welcome to our podcast series, everything you wanted to know about regulatory compliance, but we're afraid to ask. Okay, Len, so it's great to see you as always, my friend. What's the topic on today's podcast?
Well, Dean, redlining has been a red-hot regulatory compliance topic for the last 3 years. There's been a record number of referrals to the DOJ by the FDIC, the Fed, and the OCC ever since the Justice Department announced its, quote, combating redlining initiative back in 2021. And we've seen some important differences from the historic anti-redlining practices used by regulators and the DOJ since the inception of the initiative. It seems to be a work in progress, so I thought a review of redlining enforcement and the latest developments would be important and timely for our audience to hear today.
Excellent topic. Certainly sounds interesting to me, Len, and I'm certain our listeners want to be up to date on the latest regulatory practices regarding redlining and, of course, the initiative that was issued in 21. So please share your observations and insights. Look forward to it. I'll sit back and let you fire away.
Okay, well, let's begin with a very quick look back at the history of redlining enforcement. Prior to the Obama administration, redlining enforcement was based on intent as evidenced by loan applications that had been denied. Then, during 2009, regulators announced the concept of a REMA, or Reasonably Expected Market Area. This was a necessary precursor to the adoption of an entirely new approach, largely based on statistical analysis rather than specific evidence of denials and discrimination. To conduct a statistical analysis of potential redlining, you would need to define the market in which it may have occurred. So between 2009 and 2021, the regulators hosted webinars in which the key factors used by examiners to delineate a REMA were explained. Those factors included a bank's CRA assessment area, the geographic distribution of the bank's mortgage applications, the location of its branches and loan production offices, the markets covered by any marketing campaigns, etc. Once the REMA was determined, bank's mortgage applications and originations in minority tracts would then be compared to the experience of all other lenders in the REMA, and then a subgroup of, quote, peers, defined as those lenders that process 50 to 200% of the bank being examined activity. In a 2015 article in the Columbia Law School publication, the so-called CLS Blue Sky blog, they noticed the first cases brought about by what the law professors at Columbia called, quote, novel legal theories, end quote, in which they also said signal a major change in the way the law is being interpreted and applied. They were, of course, talking about ECOA and fair housing.
That does appear to have been about that time. And I remember the new statistical approach started to take shape.
Yes. And in recent podcasts about redlining, we delved into the critical concept of REMAs, or reasonably expected market areas, and how the agencies and the DOJ have shifted the practice from the approach that began in 2009 and that considered things like marketing campaigns and CRA assessment area configurations and, the de facto distribution of geographic distribution of mortgage applications, to a far less reasonable approach that delineates REMAs to be nothing less than an entire MSA or metropolitan division or statewide non-MSA. Not only have I discussed this alarming shift in regulatory enforcement, but I've also written and published a number of articles about the negative and unrealistic impact of this approach to REMAs. The latest version of a REMA began in 2022, shortly after the DOJ announced its combating redlining initiative. As I mentioned a few minutes ago, aside from the weaknesses of the new REMA approach, regulators have also used the definition of peers based on all lenders active within a REMA that process anywhere from 50% to 200% of the volume processed by the bank being examined. It hasn't mattered whether peers are banks or mortgage companies or other lenders that operate based on a model that frequently is radically different from the framework within which a bank operates. It now appears, Dean, that regulators may have recognized the inherent weakness in their approach to peer determination. That's what I want to alert our listeners to today. What appears to be an emerging change in the determination of what lenders qualify as, quote, peers for a bank.
Yeah, and I've kind of seen this myself, Len, with what we call kind of non-bank lenders, and they do such high volumes. To do a
Mhm.
comparison is just, we're seeing the results, and they're as we know, statistically significant variances, and that seems to be coming back to bite folks. But what's the latest development in enforcement of the anti-redlining practices of the regulators?
Well, it looks to me like regulators are now considering a new approach to identifying what lenders qualify as peers for a bank under examination. And that could be a big factor, Dean.
Well, what's changed?
Okay. Well, recently you and I have seen a mutual client that examiners have instructed to adjust their competitor peer market to include only those banks and credit unions that maintain deposit taking branches in the examined bank's REMAs. Once those institutions are identified, the agency has directed them to filter the list to include only those depository institutions who process 50% to 200% of the mortgage applications processed by the bank being examined. Eliminating mortgage companies and other lenders that may operate under a radically different model than banks would seem to be a much more reasonable definition of peers for a bank.
Yeah, I totally agree that it seems to be much more appropriate in the definition of peers. What were the results in the first case in which the new peer definition was applied? Do you remember?
Oh yeah, because it's still fresh in my
Yeah.
mind. It's still brand new,
Yeah.
basically. We're looking at examining the results as even today as you and I
Mm.
speak, and it definitely improved the comparison between the bank's penetration rates in the minority tracks and to minority borrowers. Banks' penetration rates remain the same, of course, because we're not judging anything regarding them. But the new peer market has reduced market penetration rates in the minority tracks and to minority borrowers. So the bank's performance actually looked better. In some markets, it changed a statistically significant result into a result that wasn't statistically significant.
Yeah.
So it potentially could have a big salutary impact on banks that are being threatened with a referral to the DOJ for redlining.
Well, for sure, that is encouraging. Maybe the regulators are getting more realistic. I'm always
Mhm.
up in the mountains, Len, and I always say, "Don't get too far over my skis," but but maybe they are. You never know. What do you recommend banks do when they're evaluating their performance for redlining issues in light of this? I'll say new development, new approach.
Mhm. Well, this is, or appears to be at least, an emerging development and not widespread, at least not yet. But I would encourage banks to experiment with this approach when conducting internal redlining analysis. I would especially encourage banks to try this approach if their internal redlining analysis indicates a statistically significant result using the old methodology. Bank may just find that the new, more realistic approach might make a big difference. Once again, this involves collecting data pertaining to banks and credit unions that maintain deposit taking facilities within a bank's REMA or REMAs. It's a bit more work, but it may be worth the time and effort. It certainly will add a more reasonable perspective on the issue of redlining, and it may offer an explanation to a statistically significant result based on what has been practiced in recent years.
My only, I guess, point of confusion, perhaps, and maybe some bankers as well, is when we're talking about REMAs, those don't typically include a branch of the bank. They're outside of their traditional assessment areas. So they're comparing the bank's activity to someone else who has a branch in that market. Is that?
Well, here's
Yeah.
yeah, yep.
Yeah.
Yeah, that's a good point. A good question. I'm glad to clarify it.
Yeah.
So a REMA is always going to embrace a bank's CRA assessment area, where of course it has its deposit taking branches. But frequently a REMA goes way beyond that area and embraces a much larger area. And in recent years, the regulators have been saying, hey, we're not going to look at anything smaller than an entire MSA. So even though a bank might have a branch or two in a given county in an MSA, it may not have branches everywhere throughout the MSA. So this is one reason why you've got to be careful and understand that a bank will always have at least a deposit taking branch in any REMA, but it may not reflect the bank's CRA assessment area. So there will always be at least one bank branch in a REMA that's being examined for potential redlining purposes. And that's the basis for this. It might be one branch. I know I looked at the Los Angeles the Los Angeles MSA back a couple of years ago and identified about a half a dozen, quote, large banks, meaning banks over $2 billion in assets, who maintained only 3 or fewer branches in LA County. And LA County, by the way, is only part of the LA MSA because Orange County is included in that. So LA County and Orange County combined are like about 3,300 or so census tracts. The bank with only 3 branches in that MSA is at a competitive disadvantage. But under the new regulation, at least their peers will be limited to other banks and credit unions that maintain depository facilities. All the non-bank lenders and non-credit union lenders, the mortgage companies will be eliminated from consideration, and also any banks or credit unions that did activity in the market but did not maintain branches.
Oh,
so
yeah.
It's not perfect. It's not perfect by any means, but it's a better, more realistic approach. I still would find fault with it because I don't think the REMA should be as large as an entire MSA. And if you have an unreasonable REMA, which is an oxymoron, an unreasonable, reasonably expected market area, you're going to be at a handicap. And I think it invalidates the findings of any analysis predicated on that. But what we're seeing at least is some move in the direction by the regulators indicating that they realize that their thesis, their statistically significant approach to this analysis has vulnerabilities that are subject to legal challenge, and they had better do something that's much more realistic. And this is an encouraging development.
Yeah, it certainly is, especially when you start comparing it to those deposit-taking facilities in those areas, because I do think that could prove more beneficial to the bank. So where do banks get this data?
Well, of course, they could go to the FDIC website and get the locations of all branches of any banks anywhere in the country. And the NCUA also has a branch database as well. And what they would do is they would capture that data and then identify those banks or credit unions that do maintain branches within a bank's REMA, and then go in and filter the HMDA reported data and limit it to only those banks or credit unions that have depository facilities in the REMA.
Well, with the aggressive enforcement of redlining these past 3 years, or maybe even a little bit more, there certainly has been a record number of referrals to the Department of Justice, but banks could use all the relief they could get. I'm certain many of today's listeners will find this podcast to be enlightening, of course, and of course very helpful at the same time, because it does provide them another avenue of testing. Who knows? Maybe may help a bank avoid a potential referral to the Department of Justice, which is what we always would love. But this has been really, really good today, Len, and I'm glad that you brought this topic to our discussion. This is Dean Stockford from M&M Consulting.
And this is Len Suzio with GeoDataVision saying, we hope you found today's podcast informative and helpful, and we invite you to let us know of any topics you would like us to address in future podcasts.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and GeoDataVision on LinkedIn for all the latest news and information on compliance hot topics.